Aggregate leverage moved from 22.1% to 31.0% in 90 days. This is not organic growth, it is a bet, and you are the one holding the position if it does not pay off. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. I have been watching this one for a while, and the number that finally made me sit up was the gearing figure, because the shift happened fast enough that I had to run it twice. Starting with the operational performance, Centurion Accommodation REIT reported gross revenue of 52.5 million Singapore dollars. That is a 2.7% variance above the forecast. Net property income followed suit, hitting 37.5 million Singapore dollars. The projected yield currently stands at 7.47%, which comfortably clears my minimum forensic hurdle of 4.7%. For a retail investor looking for cash flow, this headline performance looks solid on paper, but the sudden shift in the capital structure demands forensic scrutiny before we call it a win. To understand the true cost of this expansion, we apply the 5-layer rule to the debt. First, gross borrowings increased by 283.2 million Singapore dollars to fund the Australian acquisition. Second, this trust historically operated as a low-leverage sanctuary, and that defensive era is now over. Third, while peers like CDL Hospitality Trusts operate at 37.7% gearing, it is the rapid trajectory of this debt accumulation that is the core concern. And the stress test shows that a 100 basis point increase in interest rates would compress the interest coverage ratio from 6.02 times down to 4.78 times. The portfolio valuation increased by 16.5% to 2.19 billion Singapore dollars. This is not organic growth. It is entirely acquisition-driven. The Australian asset and new Singapore blocks. The revenue beat was also bolstered by a strengthening British pound and Australian dollar against the Singapore dollar. Occupancy remains strong at 94%, but there is a looming transition standards risk that needs naming. New mandatory spatial regulations mean bed capacity will shrink unless significant capital expenditure is deployed to redevelop older properties. Here is the financing cost illusion. Management spotlighted a 3.57% weighted average financing cost and spent almost no time on footnote 3, page 5. That footnote admits the figure excludes amortization of upfront and other fees. When you include the actual costs of securing that debt, the true economic cost rises to 3.97%. Headlining the lower rate is a classic engineered yield tactic designed to make the debt burden look lighter than it is. That 22 basis point gap compounds significantly across 659 million Singapore dollars of net debt. Now to market pricing. Because Centurion Accommodation REIT is currently trading at a significant premium to fundamental value, the stock trades at a price-to-book ratio of 1.26 to 1.32 times. This creates a glaring forensic gap. When you put it alongside established peers, the divergence is stark. CDL Hospitality Trust trades at a 0.5 to 0.6 multiple. Capital and Ascot Trust sits around 0.8. Paying 1.3 times net asset value for depreciating leasehold assets requires flawless execution and massive rental reversions. Think of it like buying a flat with only 25 years left on the lease, but paying 30% above the recent valuation price. You are betting entirely on short-term rental yields to cover the inevitable capital depreciation. Currently, 8.3% of this portfolio by valuation has a remaining leasehold tenure of less than 25 years. If management guidance on rental growth falters by even 10%, this forensic gap will close violently. As a retail investor, you have to ask whether the current yield is worth holding an asset that is structurally decaying. For my scorecard, I apply a conservative floor of 3.2%. Even though the 6-month T-bill has dropped to 1.40%, I do not lower my forensic standards to match a temporary rate trough. My floor stays at 3.2%. Sanctuary assets have to withstand a return to long-term average interest rates, not just today's conditions. On income sustainability, the gross revenue and net property income pass the gates. But 94% occupancy is not just a benchmark miss, it is perishable inventory. Every empty bed last night is revenue that is gone permanently. Closing that 1-point gap to 95% would add roughly $900,000 to $1.1 million to the top line annually. Now run it the other way. A 1% drift down to 93% does not produce a 1% NPI decline. Fixed costs do not move with occupancy. The NPI compression is steeper than the headline number suggests. We audit for the storm, not just the sunny day. Every stock I cover gets put through the same 5 hard gates: yield, gearing, interest coverage, net debt, and occupancy for property names. If it fails any single gate, the zone drops automatically, no exceptions. On top of that, I count soft flags, things like sponsor top-ups in the income line, occupancy trending the wrong way, or a stock trading above its forensic fair value. 2 soft flags, and you are zone 3 regardless of how clean the hard gates look. The result is a zone from 1 to 5. Fortress, watchlist, conditional, caution, or red zone. No gut feel, no narrative override. Just the numbers, stress tested, and a verdict you can act on. The debt health table carries the most significant red flag for any income investor. The gearing ratio hit 31.0%, failing my fortress gate of under 30%. And while the interest coverage ratio of 6.02 times currently passes, the trajectory is what matters. It compressed from 6.60 times in a single quarter. If that rate of compression continues, we are looking at a breach of the Zone 3 threshold within 3 or 4 reporting cycles. No immediate refinancing exposure, but the buffer is shrinking. Before we go deeper, if you are finding this forensic breakdown useful, the most impactful thing you can do for the channel right now is hit subscribe. It takes 2 seconds and it tells the algorithm that data-driven SGX analysis deserves to exist. And if you want the full forensic breakdown with the complete zone rationale and soft flag detail before the free version drops, that is exactly what Iggy's elite investors get. 0-day access, link in the description. Every forensic investor who reads without subscribing is invisible to the machine. So hit that button and help keep the analysis independent. Turning to scenario analysis, the bear case is a 100 basis point interest rate spike, which leads to a $2.3 million distribution cut. The base case assumes yield volatility as we approach the master lease expiry in 2028. The only bull case is full lease-up of the Mandai facility, which could deliver a small distribution uplift. But the mandatory spatial standards required by 2030 will force redevelopments at older properties, which will reduce physical bed counts and hit the bottom line regardless of current occupancy. There is an engineered yield hidden beneath the master lease in Australia. The structure guarantees 20 million Australian dollars by 2027, which management uses to project stabilized income. The forensic reality is that the vendor, heavily owned by the sponsor, is padding the numbers during the risky lease-up phase. True market viability will not be tested until 2028. Do not price this asset as if the current income is permanent. The income being reported is very real. The sustainability is borrowed. Which brings us to the forensic classification, Zone 4, caution. The rapid transition from a low-leverage model to an acquisition-heavy strategy introduces significant execution risks not fully priced into the current multiple. This is a watchlist trigger, not suitable for accumulation at this price and leverage trajectory. And the leverage spike and engineered yield structure introduce unacceptable drawdown risk for investors in transition. Distribution sustainability is contingent on master lease terms that have not yet been stress tested by the open market. Finally, ask yourself whether you are being paid enough to hold the bag. When the master leases expire and the new spatial regulations hit the bottom line, it is the retail investor who absorbs the loss. Centurion REIT has traded its defensive shield for aggressive growth, and the margin of safety has narrowed significantly. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MATS licensed financial advisor before committing funds.